Well, great. I thank you all for the opportunity to share this. It's very new to a lot of people, although I've been in this part of the financial business for almost 20 years now, and financial business for 30. But I actually got into this business because I worked at one time on Wall Street, and I went through 1987, where everybody was doing great, and all of a sudden the bottom dropped out, and it didn't matter how good you were, everybody lost money. And so I was looking for something else that was what I would call a fixed asset class, which is what this is. It's an alternative asset class, like a piece of real estate, like other things that we do and hear about. It's becoming more and more and more popular, and people are becoming more and more aware of it. So what I'd like to do this evening is just give you like a pilot's view of what is a life settlement, how does it function, things to look for, how you can tell something's good or something's bad, these type of things, just to give you an overall feel for the business, for the industry, and where it's going. But I can tell you it is growing significantly because the US population is growing, the senior population is growing significantly. So when you see the first page of the presentation, it says unveiling the inherent value of U.S. life insurance policy while reducing risk in an increasingly volatile world. Well, who can not say that it's a volatile world we live in? But a U.S. life and policy, one of the first things you learn if you go to an insurance class is it creates an estate. It's an annuity, they'll tell you, it diminishes an estate, but a life insurance policy creates an estate, and it's a very strong asset by U.S. life insurance companies, and it's the envy of the world, basically. So that's what we're going to get into now is the inherent value, what makes it such a great product, what makes it so valuable. And the American public, in most cases, don't even realize what they're sitting on. And that is, it's a piece of property that you own, and you have a right to keep it or to sell it. Now, the insurance companies aren't real happy about you selling it outside of what they give you when you go to cancel a policy, but you have a right to sell your policy just like any other piece of property you own. So keep that in mind as we go through this. It's your piece of property. It doesn't belong to anybody else. So think on that. So life settlement. And again, I won't go to line by line, but I will get the intent of each slide. A life settlement is a financial transaction in which the owner of a life policy sells as an unneeded policy to a third party for more than its cash value and less than its face. So it's discounted and it's sold in the marketplace. And I hate to use the example, but it's very similar to a car and a used car sale. You get a car, here's this guy, he sells the car, then he may sell it again a third time, then he may sell. That is absolutely what's happening now in some cases in the life insurance market. The policies are being bought and sold, and they're a piece of property. A life settlement is an alternative to a surrender or lapse of a policy, or when the owner of a life policy and the policy is underperforming or could no longer afford to pay premiums. You know, a lot of times we buy these life policies when we're starting our families, and like we don't want something to happen to the breadwinners or the husband or the wife, or what am I going to do? Something happens to my wife. So you buy a life policy, great thing. But then as life goes on, you're still paying, and the policy basically isn't what you need it for anymore. And so it becomes an unneeded asset. And what a lot of people do is they lapse the policy. They just say, I'll quit paying the premiums. But when they do that, understand this, the largest profit center US life insurance companies have is lapsed policies. And most policies lapse by year 10. And that's when people quit paying them. And so you pay premiums all this time. They get to keep your premiums in a lot of cases, or sometimes give you a small percentage when you go to cash out, if it would had cash value in it at all. And they're sitting on a large pile of cash. and multiply that by thousands and thousands and thousands of policies. So what the life and settlement industry has done is made it a way that you can sell that to somebody else safely. Okay, there's safe ways to do that and get paid for it. So it was held legally valid by the U.S. Supreme Court um, since 1911. And the progress of medical underwriting made it an active investment market. Life settlements is a financial transaction become a way to help policy owners who have the need to tap a formerly unidentified asset and use it in the best interest of the policy. Now, this is really an important point, number three, because I can't tell you how many people have sold their policies, and we've gotten letters from that, oh, I was able to stay in my home because they had no other way to stay in their home except they cashed in their life policy and they had a way to do it and they sold it. Or, as in the case of one lady, she wanted to buy her three kids' homes before she died. So that's what she did. She sold her policy. It was a large policy, about $10 million, and she sold the pieces of the policy, and her kids all got new homes. And she was able to see that while she was alive. So other cases are you can donate it to charity. You want to donate it to your church or to a charity. This is common practice. Nonprofits get donated policies all the time. You see on the television now, they're even donating cars and real estate and everything else. They're not mentioning life insurance policies, but it is happening. So again, it's an asset that people aren't aware that it is truly an asset that can be bought and sold. All right. So, and one other comment. Some people say, well, that's kind of morbid, selling policy and some waiting for somebody to die or something like this. I just want to say this. It is a business transaction. It's a button down business transaction. And there are doctors and hospitals and funeral homes making money every day on sick and dying people. So it's not that you don't have a conscience because you bought somebody's policy, or you don't know who they are anyway, by the way, if you bought somebody's policy. But the point is it is a business just like all the other businesses that, make money. Okay. Okay, this is really important. Life insurance company reserves, in 1929 when we had the stock market crash. And by the way, I like the stock market. I love the bond market. I love real estate. All of those things are great products. But, true diversification doesn't mean all of it in one place. It doesn't mean all in stocks. It doesn't mean all in mutual funds with the same mutual funds having the same stocks. The same thing applies to bonds. It's the same thing applies to real estate. Uh, there's upsides and downsides to every single financial product, just there is in life settlements too. But true diversification is true diversification. And life insurance companies have much stricter requirements regarding the cash reserves that they maintain. By law, the insurance in all 50 states must have, this is important, at least $1 in cash reserves for every dollar of premium that is issued in the form of annuities or life insurance. Just imagine that. So what that's saying to everyone is, and if you're not aware, it's okay, but it's not fractional reserve. In other words, they're not holding part of the money for another part to be returned later. They're holding 100% of the money and sometimes more than 100%, as in the next paragraph says. In other words, the life insurers must keep at least 100% of their deposits at minimum reserves. Many insurance companies actually go beyond this, maintaining a reserve surplus above 100%, so they can make good on their guarantees to policyholders. That's what makes a life insurance policy so strong. And in that, they also have policies have ratings just like bonds have ratings, just like your stocks have ratings, and they do too. So it's a Comdex rating on life insurance, basically. They use AM Best, Standard and Poor's, Moody's, Fitch. They use all the same ones that are used on the bond markets and the stock markets. And what you want to look for in a life settlement most of the time is an 85 or better rated Comdex rating. Now, most people have no idea what the Comdex rating of their life insurance policy is. And sometimes there's some big names that have not so wonderful ratings, and there's some others that surprise you. So all you have to do is go online, pull up Comdex ratings for this company, and see what your insurance company. Even I will tell you this: most insurance agents don't even know that that is a thing, that a Comdex rating, what it is, and how the ratings work, because that's not their focus of their business. You know, their focus is to understand life insurance products that are offered by that company. All right. So just it's important to recognize. Okay. So the life insurance industry happened because of progress in estimating life expectancies has created an active investor market. And there's a dire need for our aging population, as we mentioned before, to maintain the standard of living. By utilizing the inherent value of a life insurance policy, life settlements provide economic opportunity for the policy owner and the purchaser of the policy. And let me say at this point that you can buy policies individually, you can buy them through a fund, you can buy them through, and I can tell you that there are financial institutions buying these. It's no secret Warren Buffett buys 500 million a year. There's all kinds of places you can go to check on like how much the industry is. I'll give you some numbers as we go through these slides. But the point being is that it's a huge market, and even institutions are buying them. So if an institution wants to buy life settlements, why wouldn't you? Why wouldn't you be interested in doing that too, as a part of your diversification of your portfolio? The market size and growth, let's take a look at that. The secondary market of US life policies is expected to grow over 160 billion over the next decade. The primary market of US whole life policies is worth 9 trillion, which indicates a life settlement penetration, get this, of less than 1%. So of all the companies that are selling all the life settlement policies, the penetration of that is only 1% of the entire market. As the number of people over 65 increases over the next 25 years, the number of policy owners willing to sell their policies will increase significantly. Absolutely. Why wouldn't you want to sell your policy? So at this point, let's talk about there's two sides of the life settlement transaction. There's the sell side. You have a policy. You want to know, can I go in the marketplace and sell it? Yes, the answer is yes, you can. You can, sometimes it's done directly with you, the client. Sometimes it's through a broker network. Sometimes it's through a provider who the brokers submit policies to. It's just like a marketplace for automobiles or for houses. It's the same kind of arrangement. There's brokers, and on top of the broker, there's providers, there's fund companies, there's all of these things going on uh, in the background. So people can use that market to your advantage, and they're going to be using it because, again, you can free up an asset that you had that you didn't realize you had. And now maybe you can pay off that house that you've been paying for 25 years of the 30, and you can live in that house. All you got to worry about is your electric and water. So this is the kind of thing. It's the buy side, I mean the sell side, and then there's the buy side. The buy side, you can buy it as an investment. And we'll go over, how that's done. You can do it through an IRA. You can do a 401k transfer to a self-directed IRA. You can do it a 501c3. You can do it as a nonprofit, and you can invest in these across the board. So you can do it. You just got to work with people who know who the custodians are and who will handle your self-direction. But it's your investment. You can do what you want with it. Okay, advantage of the settlement asset class. Policies are issued by A-rated U.S. life insurance companies. Yes, they are. That's part of that Comdex rating I was talking about. 85 or better is usually not that they're the ones that are lower than that aren't good companies. They still have to have one-to-one reserves. It's just the 85 or better have even more than 100% reserves. All right. So just keep that in mind. Unaffected by market or economic conditions. Yeah, it's a non-correlated asset to the market. Doesn't matter what the market does. What if you bought a life settlement or if you sell it, the market has nothing to do with it. Opportunity for growth and income yield? Yeah, it is. There is opportunity for growth and for income yield. Uh, Perceived low risk investment capital. It is if you have to, understand how the process works, how the asset class works, you know, uh, and then it is a low risk because it's backed by a U.S. life insurance policy uh, that can be used to help liquidity and provide liquidity without having to sell other assets at a loss during a time of emergency. Okay, so there you've got some stocks, you got some bonds over here, and you got to wait out the stock that just dropped in the last month or so, excuse me. So when that happens, you can sell your policy maybe and create some capital you didn't have. Just an idea. And the true diversification risks that I talked about. So sorry about that. Uh, yeah, so then typically there's basically these client objectives, sometimes there's companies that prepare them like a bond portfolio. And when they do, they have what's called different insurance carriers, different life expectancies, different age of the insureds, different underwriting on each of the insureds. And so they build a portfolio, and it's quite extensive if they do it properly. It's like modeling a bond portfolio, except you're doing it with insurance carriers, insureds, policies, the type of policy, et cetera, et cetera, et cetera, et cetera. So it's extensive, but as an investor, you can buy a portfolio of them and have somebody build you a portfolio of the policies. Works really, really good, especially good in IRAs, because in most of those portfolios, you are in the policies, and as one comes due in your IRA, it can grow within your IRA without having to take it out of your IRA. So it's a good product for buy and hold. Then a client may have um, one income stream. Well, there's some out there that offer income stream products where you can gain an income off of a policy portfolio that's being held, and off of their maturities, they pay an income rate and interest rate. And there's a policy and the policies backing, again, those two products. So there's policies backing the portfolios and there's policies backing, an income stream if that's what you were looking for. Uh, Organization and service providers. Well, independent trust company is something to look for. These are all very important. You don't know companies in the past that have gotten in trouble in the life settlement business or back in the early years, which was a bad word called viaticals, always did not do these things, which are what? Independent insured tracking firm, someone outside of the company itself that's tracking the insureds. And there's companies that do that. They track them all over the world. They track them, part of the sale of a policy is they give permission for you to contact them and their nearest relative. You check the tracking companies check the pension rolls. They know, they know when somebody deceases. And so, but that needs to be independent of whatever company it is that you're working with. Why is it? Because it's transparent. Because a maturity can't happen, in other words, unless it goes to there first and they know about it. So it's a safe way to do it. Uh, then you usually have a corporate law firm involved. Here again, we have the independent actuarial medical underwriting firm. When you look at companies like this, you want one that does actuarial and medical underwriting, not just medical and not just actuarial. And you definitely do not want that has a medical underwriter in-house again. You want them external to the effort. Why? Because then there's no vested interest in that underwriter with the company. It's out there. They pay for the service. And you look at the various life expectancies, the company who buys them, and they say, I don't want this one, I want this one, I don't want that one, but it's independent and it's actuarial. And actuarial means just what the insurance companies do and how they made all their money. They estimate someone's life expectancy on the actuary tables and they pull it up and they know your height, your weight, your familial history. They know all of it. And when they check it out, you fall on the table. And I predict in the next probably 3, 5 years, it'll all be AI underwritten regardless. If these people have this kind of condition and this age and this, it's going to come out way quicker and everybody will know what their life expectancy is. Maybe a little scary to some, but you know what? It gives you an opportunity to plan. So look at it in a positive light. Uh, there's policy originators. It can be, like I mentioned earlier, through brokers or individual insurance agents. Maybe this guy who sold a New York life policy 20 years ago, you no longer need it. So he'll come back and he'll say, you will tell him, hey, I want to sell this policy. Then he'll go find a firm for you who'll buy it. And then there's brokers out there who broker policies and gather up 50, 100,000 policies at a time. And people will go out there and model them, look at them, decide whether they want to buy them now or they don't want to buy them. What's the life expectancy? Is it 5 years, 10 years? Can I live with that as a client? And these type of things. But that's where the policies are gotten from. They're gotten from the marketplace or directly from the people who bought the policies that are the owners. And then, of course, there's accounting behind it and self-directed IRA custodians who work specifically with life settlements. Not all do. Not all are good. There's some very good. So it just has to be, research needs to be done. You need to know who you're buying it from and who you're going to put some of your IRA funds in, maybe. Okay, part of what I was mentioning in that earlier slide is independent actuarial medical underwriting firm. It's an independent firm will be engaged to underwrite projected life expectancy of all insured individuals insured on policies received from the policy originators, wherever they came from. Uh, Typically, a good one will have like this with over 50 years experience in respective fields. An underwriting firm consists of medical staff, actuarial staff, professionals with Six Sigma certified rating, which if you know what Six Sigma is, that is the highest quality rating you can get. So that's a good medical underwriting company, medical actuarial underwriting, both. Remember I said both. It's really important that it's both. It's not just one. Uh, More of the underwriting, this is such an important part of the whole process because if the underwriting isn't any good, the product won't be good. In other words, what you thought was 5 years is now 10 years. But if you have good underwriting, nobody knows the exact point in time when any of us will pass. But we do know the range. And as long as that range is with what I call range of reasonableness within a 24 months or so of when it was estimated, then that's a pretty good range for the amount since there is no risk to your capital. So they have statistical modeling, medication compliance, medical research, actuarial science, they look at geographic locations, type of current treatments, how the drugs are affecting people, pathological factors, continuous testing of models to ensure that they remain as accurate as possible. So they model, just as the people who acquire policies model the policies, so does the underwriting company. They model the policies as well. All right, this is a servicing record of someone I know of, and here's their servicing. Zero number of involuntary lapses, 38 average number of days between death and notification. That's pretty unbelievable because the insurance carriers are not that fun to deal with. But this is why you have a professional servicer servicing the policies. You don't want to be doing it yourself. Trust me, you will spend more time on that phone getting nothing and no answers or slow answers, which is the typical, and especially during COVID, it was a nightmare trying to get somebody who was in the office working at some of the carriers. Uh, I know because I called and I had 5 lines going at one time with just one place trying to get through for several hours. So this just shows you what can happen. You want a servicer who's going to be servicing your policies. Uh, percentage contacted directly within past 6 months, 0.15. Average number of days between notification and receipt of payment. This is extremely important, 55 days. Now, if you're a client who, well, that's too long, then this is probably not for you. This is not, if you're looking at life settlements, either to sell your policy or if you want to invest in them, if 55 days is too long for you, probably don't want to do this. It's not for everybody. It's for an addition asset class to your current investment portfolio. That's what it's for. And you can do it safely and you can do it in the proper way, but it's not instantaneous. So, but it is 55 days. You can count on that 55. That's the average number of days. So sometimes it's 3 weeks. I'd say, I've seen them most of the time now. It's processing because the insurance company has to make interest on those funds until they pay out. So the bigger the life policy face, the sooner they're going to pay. You would think it's the opposite. No, it's not the opposite. They don't want to pay the higher interest on the bigger face. So the bigger face you got, the faster they're going to pay. Just sidebar there. All right, and then there's IRA custodians, which was mentioned earlier as well. And IRA custodians, uh, they will take, you can roll it over to an IRA. You can transfer an IRA. Uh, you can do almost any plan that you can self-direct. You can do with an IRA custodian who works with life settlements, and they are out there, and there's some very good ones too. And it's a great diversifying thing. Just imagine you've got your self-directed IRA, you got some funds, you got some bonds, you got some stocks over here, and here you've got some life settlements and some real estate. And by the way, I was on the board of the Real Estate Association of Palm Beach for 12 years in the Professional Development Committee. And I love real estate. I absolutely love real estate. But I love life settlements too, because you don't have the way to look at life settlements is similar to a piece of real estate in that piece of real estate has a property tax. A life policy has a premium. All right. And so they're very similar, but they're all asset backed. What by the property? What by the insurance carrier? So if you just look at it like another asset class that you can use and utilize, and you can liquefy it where it wasn't liquid before, it could be very helpful to you. Maybe you need to sell it, or maybe you want to buy it through your IRA, and an IRA custodian can help you do it. And then, just to learn more, you can call us at this number. They'll schedule an appointment. We can visit with you, and we'd love to talk to you and love your feedback. We try to make this as informational, educational. It can get very complex. It's more complex than what people recognize right off the bat. But there are companies, there are individuals within the industry who really know what they're doing, and they treat the product like what it is, a true financial product. So we'd love to hear from you, and I really appreciate your time this evening. Thank you.
All right, Russ, let's answer some questions. The one that I saw 2 or 3 times, does this apply to whole life or term insurance? And I believe you said it applies to both.
Yes. Okay. So let me quantify that. So there's really three types of policies. There's whole life, universal life, and term. You can sell all of them. Okay, let's explain it. A term policy. Why would somebody want to buy this? Pure insurance. Because someone can buy it and convert it to a UL policy. One of the 7 mandatory provisions of a life insurance policy is your ability to convert. So you can convert any term policy to a UL policy. And then can that be sold? Yes. Can that be purchased? Yes. Whole life? Yes. The only thing about a whole life policy that is not as good as a UL or even a term in that case is the premiums are fixed. The premiums are fixed throughout, and all the whole life policies, you are paying more than the face value, than the premium. You are paying more than the premium. Now, in a UL policy, you can pay more than the premium. In fact, you can pay what's paid up additions and pay more and then get more insurance from it. That's a good thing to do. But most of them don't share that with you. So, if you just want pure insurance, a UL gives you the most flexibility because you can pay pure insurance, or if you want to start paying more, you can start building some cash value in it. And a whole life, you're going to build cash value in it, whether you want to or not. And a term can be converted. So all three are applicable.
Okay, let's start off with I want to sell a policy. Okay,
Okay.
so what determined, let's say I've got $1 million policy because I can do the math on that maybe.
Mhm.
What determines the value of it? Is my age, or is it my health, or is it all of the above, or what are we looking at? What determines the value that I would get out of my policy?
Okay. All of them look at all of that to answer your question.
Okay,
So they look at your age, but it's not just age, because someone can be in their early 80s running marathons still. It
okay,
happens. Uh, so they look at your age, they look at what prescription drugs you're taking, they look at your health and heart history, they look at everything. Everything. A good company will share the medical underwriting with you. You have to, if you're selling your policy, you've got to sign a release, and then they go and have it underwritten, basically. And they get
okay.
it underwritten, then they come back with what's called a LE, a life expectancy, on what that is. Now, depending upon other things like what's the premium? Is it a good policy from a Comdex rating? Is it a good company? Is it, they weigh all that, like I said, there's a lot more involved than just first meets the eye. They model it. They model it across the board. There might be 25 columns in a spreadsheet that they're looking at that says, okay, this is a policy I want now. Or maybe they'll say, I don't want it now. I want it, and I'll come back to this person in 7 years from now. I mean, it doesn't mean it's a dead issue even then. It could be sellable maybe a little later. Maybe you're too young. Although there's some that have sold policies, usually I would say it's 70 and above. However, there's people with health issues and in a real bind or something that 65, 68, just depends. Maybe they need that money and help a family like right now, or their medical right now. Then that's an issue they take into consideration, and the policy can be sold then.
Okay, so I know that you'd be getting in trouble if you gave averages, but give me some idea. What if I get $1 million policy and
Mhm.
I'm 70 years old? What are we typically looking at to be able to get 40 cents on the dollar, 30 cents on the dollar? What is typical?
Yeah, so remember this, that whoever buys that policy has to keep paying those premiums. So whatever those premiums are, they're going to be paying indefinitely until the maturity occurs. Now that's all confidential information, but yeah, that's so they figure that number in. And then again, they figure in the life expectancy. Did it come back as 10 years? Did it come back at 5 years? The shorter the time frame is, the more they pay for the policy. The longer the time frame is, the less they pay for the policy. So in other words, if your life expectancy is 10 years, they're going to pay less for that policy than they're going to pay for someone who's came back with 24 months. So
Sure.
so those are the considerations. What can they look for? Anywhere from, I would say, 30 to 40%, 40, 50% sometimes. Just depends on, again, all those other features that are, the policy itself and the attributes of the policy and the carrier. It's not just on the insured, it's on everything else involved too.
Okay. Well, we get a lot of questions. Mark is asking, what kind of yields does this asset class typically get?
All right. Good point. So usually I would say, remember we looked ahead the slide like I gave as an example on a portfolio, where you had a portfolio of policies, portfolio meaning three, four, five policies. There's usually a minimum investment involved. And then it's usually about 10% annualized return based on the life expectancy. So if the life expectancy is 5 years and you have 100,000 in that one policy, you should get 60%. So you gotta, and that is when the guy deceases, when the maturity happens, or the maturity happens, period. So if it happens in 3 years, you're still gonna get 160,000. Happens in 7.5 years, you're still gonna get 160,000. You know what it is, you just don't know when it's gonna be. And the normal
Okay.
time frame is 10 years or less. For portfolios, they're really good for IRAs, and 10-year time frame is a great scale. You can just about, I would say you could double your money most of the time in 10 years. Now, on the
Okay.
income side, they usually they have things like I would say they pay a quarterly interest rate, depending on how much money is in. They might pay 7% a quarter, and at the end of the 7-year term, you'll get your money back. Or they might pay 10%, but you're going to have $1 million in, and then they'll give you uh, pay quarterly, and then give your principal back at the end of the quarter. They're not keeping your principal. They typically are just paying you for the time of the use of the money, and they buy policies that back your investment. So those your money is actually backed, and then they're paying you interest in advance on the maturities. But their portfolio is already spinning and cycling maturities. So they're able to do that.
Okay, but this is not an investment. If I've got $100,000 to invest and that's all I have, this may not be the best investment for me. I don't need
No.
to be an accredited investor, but I'm also not liquid enough to be able to pay the premiums if I need
Yeah,
to.
no, no.
Correct?
Well, most of them, there's some of them where you have to pay the, sorry, no, you have to pay the premiums, and there's other ones you don't pay the premiums. 100% of your money goes to work for you. The
Okay.
thing is there's always, in these cases, there's a couple things that happen, and this is something I didn't explain during the presentation. I'm glad you mentioned this part of it. There's some companies in the business, what they did is they fractionalized policies. In other words, Don, you own a piece, I own a piece, this client over here owns a piece, they own a piece. And well, that's a bad deal because then they were forced to pay premiums. And if they couldn't pay premium, then it became on you or me to pay the premium. And then if you or I couldn't pay the premium, the policy defaulted.
Ooh.
All right. That's a
Yeah.
bad thing. But if
Yeah.
you've got a company that pays the premiums and 100% of your money goes to work for you, then that's a good thing. And so you'll have 4 or 5 policies that come in. And if someone needs their money out of there, then usually that would be like a forfeiture clause. In other words, you're not going to get the return, but you'll get your principal back. So in other words, you have 5 policies, you got $500,000 in, and somebody, I need money because of a medical emergency. Okay, cash in one of the policies. You're not going to get the return, but you'll get your principal.
Okay.
So, it's not like an annuity where you're actually giving up part of your principal too, usually. You get returns for 2 years, and then that's, during a bonus or something, and then they start eating away at your principal. That's not the way this works usually. And then, on the other hand, I mean, in institutions, let me say this, institutions are buying those 10-year, 10%, and they're buying 15% with $5 million in. I mean, that's it's being bought day after day after day after day. Now, if you've got 100,000 and that's how much you got, it's not the right product for you. I'm sorry, it's not. It's
Okay.
it's you need to buy something safer. Not say I wouldn't mean it's safe like that, but I mean this is an alternative. It's not something that's just you have to be patient with this to a certain extent. I mean, on the income side, you're going to get your payments. That's very good. You're going to get them timely. You're not going to get affected. Your principal's not going to get affected. But people look for, you know, people with more assets than that to invest in. That's all. They just,
Would it be fair to say that the returns are typically much higher than annuities?
yes,
Yeah.
absolutely.
We just don't know when.
We just don't know
Somebody's
when.
gonna
Again,
die. Yeah.
the portfolio side, it could be, 50% on 100,000 and in less than 5 years. It could be, it just depends on the maturity. On the income side, Yeah, they're paying you 7%, or they're paying you 10%, or they're paying you 6% for 5 years. And it's not like it goes away in 3 years. I mean, it's not like a bonus thing. It keeps going until the end of the term. And you can either renew or you can pull out, whatever you want to do. It's your money.
Okay, David is asking if purchasing a whole single whole life policy, can it be used for infinite banking?
Yeah, possibly. Yeah.
Okay. Now, you both buy policies from people and you sell this as an investment, is that right?
That is correct. We do it out of we have, well, three now private funds and two international funds we're working on currently. Yeah.
Okay, Kendall, would you put that phone number in the chat screen? Oh, wait, I think you already did. There you go. There's phone number. And so students, if you wanted to talk to him, to Russ or somebody in his office, either email or contact Russ. If we don't get to all your questions, there you go. Contact Russ. Okay, in the chat screen, just click on that and that'll take you there. Okay. Can I buy a whole life insurance for myself on the secondary market? Would it save money over buying a new policy?
That's a very good question. Now, I want to share a little story about this. So, I met one of the economic advisors for the president at a conference near an elevator, and he says, "Where are you going?" I said, "I'm going up to Palm Beach." He says, "Can I have a ride?" I said, "Okay." So we're in the car talking, and he's telling me my wife is on me like crazy to buy a life policy. And here, this guy's probably in his early 50s. And I said, "No, buy somebody else's." I mean,
Oh,
why would he buy one for himself in his 50s and pay the highest prices you can pay when you could go out and buy, say, somebody else's policy who's way sicker or worse in health than you are? So that's the answer to his question. Yes, you can go out and you can buy one, you can buy 10, you can buy as many as you want. And, you're just gonna, if you buy it here's my point. If you buy it through a company, then they will take care of the premiums typically, unless it's fractionalized. If it's fractionalized, you're going to be paying the premiums. So I don't believe in fractionalization. I don't think anybody should. It's been the nightmare. It's the bad part of this business is that particular thing. But you can go out and buy a policy out in the marketplace and pay the premiums and but you're not going to have the expertise to go through the underwriting, like who underwrote this? Where am I going to get it underwritten? How do I know it's a good underwriting? And all the rest of it. I'm just saying, if you buy it as a package, it's easier than doing it yourself from scratch and trying to do it.
okay. Jesse is saying, so what does your company do? Russ, clearly you know your stuff, but she's asking, do you invest in them privately? Are you a fund? Are you a market? I think you answered that, but maybe be real clear. You buy policies, you sell investments.
Yeah. Okay.
Clarify
So
that for
let
us.
me answer that. Yeah.
Yep.
Well, we do have a succession planning company that's a consulting company that we have, and that's what's titled here. Well, I didn't put we do have currently uh, three private funds. One's institutional, one's accredited investor, and one's investment club. So depending upon where you fit, for the institutional one, the higher dollar requirements are for that one. That's for frankly nonprofits. Even we have mutual insurance companies, property and casualty companies, credit unions, and the like. So that's for institutions. And we have another one that's for accredited investors, $1 million net worth, excluding your primary residence. You can include your equity. Okay, you can include your equity, but you can't include it, what your non-equity is part of your assets. So it's part of a requirement to be able to do a private fund. So you have to have $1 million net worth. You have to have either accountant say you do. You have to give a wealth statement, and you have to sign a notarization. That's our, not our requirements, it's the requirements of the SEC. And then thirdly, the investment club one, if you don't have, at least $500,000 minimum investment, you can do it through the investment club one, which my son runs. He's got a master's degree in finance and economics and been working with me since he's been a youngster. And he runs that fund and co-manages the other two with me. We share back and forth both funds. So yes, we have three private funds currently. We're working on two international funds as we speak.
Okay. Theodore is asking, I have a $50,000 term policy that my deceased mother, she's listed as the beneficiary, but she's not here. No premiums are required. What can I do with this policy? He's Canadian.
He's Canadian. Okay, that's a little, and where's the policy? Where's the insurer domiciled? Is it
I don't know.
US?
Okay, Theodore, see if you can answer that and we'll come back to you.
Okay.
Deborah, if I buy a life settlement policy outside of a retirement account, what are the tax consequences to me upon the death of the insured?
Okay. Uh, there's a couple opinions about what that is. So my go-to, one of the tax people Don has is one of his experts is my expert. Uh, and he would tell me to tell you, check with your tax consultant and see what I'm have you do. So that's going to be my advice. I will say this, it can be treated as a capital gain. Some do, some treat it as ordinary income. Some do. It just depends on what your accountant is and you are comfortable with doing is how you claim it. I have nothing to do with that. I'm not giving tax advice.
Okay, so Leon, I think that answered your question too. I hope so. And if it's in an IRA, then we don't worry about tax consequences, do we?
No, no.
Okay. What is the return on investment for someone who buys a policy? I think we covered that. Please explain how it works if I buy a policy through a fund.
Okay. So you can do that. You can buy more than one, actually. The policy, like the company, the way we do it is nobody, like I said, is fractionalized on a policy but you. But what we do is the company holds the any balance of position ourselves. So in other words, we have a vested interest in every single policy that is bought through us, of which we've analyzed, of which we modeled, of which we. So in other words, if somebody has $300,000, we can usually do two policies. We can put them in two different policies, maybe three if we get lucky and find a smaller faces to do that with. So he can be in three different policies and get a 10% annualized return based on the life expectancy on all three. So his average is, it always comes out, to a 10%. So it's a great product. Again, though, if you have 50,000, you would be better off with the investment club fund than with the accredited fund.
Okay. Can an investor buy a policy in an IRA? Yeah, I think we've already covered that.
Yep, sure can.
What parameters do you like to use for investing in life settlements? I think we covered that too.
I can cover it. Let me go over that real quick.
Yeah, yeah.
So we're looking at the carriers, we're looking at the premium to face, we're looking at the cash value, we look at the type of policy it is. Uh, we run illustrations on all the policies. We see there's things that happen like that are invisible to almost everybody. And that is like if you pay a premium on time all the time and you've had that policy for 10 years, believe it or not, if you run an illustration, your illustration will show less premium than a different person who had the same policy who was paying late. They kept the policy in force, but they paid
Huh.
it late. So guess what happens? They get a different illustration. And so they're making a different payment system than the ones that paid on time. Nobody knows this, only actuaries do, but I hire actuaries, so that's how I know. Not because I'm so smart, I hire guys who are that smart. Okay. So that's the way that works. And I want to mention this too, Don. the way we do it is sometimes if people have enough in enough assets, we do a combination in the IRAs of both. In other words, we do some on the income side where they're getting their income every quarter sent to them from
Sure.
the IRA custodian. And then we have the portfolio side, we call it the growth side, where they're in a portfolio of two or three policies and they got a chance of maybe, an early return, which could be hugely significant. So we do both, or they can just be in one or the other. I'm just saying that option, it's kind of like if they're familiar with, when you go into an index fund or something like that, you have multiple things you can choose from to give you different allocations. That's what we have. We have different allocations within the funds. So just wanted to mention that.
Okay, our Canadian investor is back. He says the insurance policies are all Canadian. So again, the question is, I have a $50,000 term policy listing my deceased mother as beneficiary. No premiums are required. What can he do with the policy?
Why didn't he cash it in at this point if she's deceased?
Well, I think the, the policy looks like it's on him, but listed the deceased mother as the beneficiary.
Oh, okay, but is he the owner then? Let me just say this. I can't vouch for a Canadian insurance company, but what I can tell you is that this is a little tricky because it may be on him, but is he listed then as another beneficiary, or who is the owner of the policy? That's the key question. Who owns it?
Okay. Okay, there you go, Theodore. We'll come back to you.
Sorry, we'll try to get as close to an answer as we can for you.
Okay,
He says
and I
he's the
think
owner.
he is the owner.
Yeah.
Okay.
We lost your camera, Russ.
We did?
Oh, he's still there. He's still there.
Oh, yeah, okay, there we go.
Uh, yeah, yeah. So, I mean, I can't say about a Canadian policy. I know about our policies. I don't know if they allow that. I don't know how the Canadian insurance industry works necessarily.
Okay. Just to be clear, does your business sell someone's life insurance policy to us investors? And if so, what are your fees?
Okay. So typical fund fees are 2%. Okay. 100% of your money goes to work. That's part one. So the fees are from the fund itself, 2% and 20 of the profit. That's the industry standard for all hedge funds, private funds, and the rest. 2% upfront of the amount, 20% of the profit. But again, if you give us a 500,000, $500,000 is what's going to go to work for you. It's the pool of the money that's going to pay us our fees.
Okay, good. Um, can an investor build a cash value in the policy purchased, which said investor can borrow?
Yes, absolutely. That's one of
Okay,
the key features. That's a beautiful thing. Frankly, that's probably one of the best features of a whole life policy is that if you've got enough cash value in it, you can borrow at low interest rates.
okay. Deborah, about your $1 million term policy, what are the consequences, tax consequences? I, again, it's
Is
either
she
earned
selling
income or
it or what's
capital
she doing?
gains.
Yeah,
Yeah,
she has to, yeah.
okay,
There'll be a tax. It's not like it, it's different than if you inherit the money like from a relative and you had a policy on them and they died and you get the proceeds, it's tax free. It is like the only tax free thing on the planet Earth. But when you go and use the product as a tool or a financial instrument, you will pay a tax for it. Okay, are we clear? So if it's a normal life policy you're a beneficiary of and they deceased, you get the money, there's no tax. But if you use it, a buy a policy, exchange a policy, purchase, then there is a tax involved.
yeah. And I said earned income, and it wouldn't be treated that way, but it would be treated as an investment income or a capital gain. not
Yes,
subject to self-employment tax. Okay. My
correct.
policy has 10 years paid into it. I'm in the ninth year. Oh, wait, 10 years. He's in the 10th year. What would I get if I sold it? Well, it depends on so many other factors. Right?
Right, his age, what the is, does it have cash value? How much is the cash value? I can tell you, year 10, the insurance company is checking the clock, then hoping you don't pay anymore.
I'll bet they are. So that would be a really good question to ask in a private consult where they could get a little bit more information from you. Is that fair?
That's fair.
Is there a minimum amount Sophia's asking for an investment?
Yes. The if it's through the investment club, it's 300,000. If it's through the other fund, it's 500,000, and the institution, it's 1 million.
Okay. Well, that's good to know. Yeah, that's glad you asked the question. Good. Um, how do I find companies that sell these assets? Well, just happens to be that we have somebody on that sells assets.
Yeah, I can always get them in. I can get them in touch with the top people in the marketplace that, sometimes the ones on TV aren't necessarily the ones you want to go to. Uh, there's people out there that do a really great job and that really hunt for buyers of certain policies. Like I said, I mean, we look at literally 100+ policies at a time, and we pick like 5 or 7 out of the 100, and this is constant because it's just not doesn't fit the right thing for us. Doesn't mean they're bad, just it's not fit what we are trying to accomplish with our objective. But there's other people out there we know who do, and that's another thing that I'll mention, that we buy policies out there that really nobody knows we're buying, and we do that on purpose because it's one of those things you don't want to let the other side know who's doing what. So that's what we do. We've got buyers out all over this country. We've been doing it 20 years now, so we do our thing and we just go about our business.
Okay. Do you have a website?
Yes, you can go to there's three actually. www.epmfund.com, estate portfolio management, epmfund.com. The institutional one, if there's been any institutional questions, is continuationmanagement.com. And then there's the investment club one, which is Haerri.com.
Okay, Kendall, did you catch that? And can you?
So Russ, I have epmfund.com and continuationmanagement.com, correct?
Yes, and then the investment club one is Haerri. It is Haerri BCPF.com, Venture Capital Private Fund.com.
So
Okay, Richard is saying if I buy a policy and then pass away, what happens to my investment? Well, now we're getting into an estate
Well,
planning.
they sign in the subscription agreement, there's who's your beneficiaries, who gets what percent. If
Okay,
it's in an IRA, the IRA custodian actually takes care of that. But if it's not IRA, non-qualified funds, then it's on the subscription agreement. You want 30% of this one, 20% of this one. We distribute according to your instructions because remember, that is a notarized document. So we follow the instructions.
yeah, if it's an IRA, whoever becomes the beneficiary of the IRA because the IRA owns the
Right.
investment.
That's right.
So can you buy someone else's whole cash, whole life policy through you?
Yeah. Yeah.
Yeah.
What I'll probably do, let me answer that. Probably not. I probably wouldn't do that. I would send them to one of the brokers or providers we deal with, and I would just have them deal with them directly. No problem.
Okay, if the policy is in the IRA, will it be required to have minimum distributions? Yes, Barbara, it will. Just normal
like normal IRA requirements.
Yep, nothing new there. Who are the beneficiary listed on the policy when it's fractional ownership in a fund?
Okay, there's no fraction. Again, we don't fractionalize. So there is nobody on that policy except the investor or the we like to use the word purchaser because it's an asset class. So that purchaser or maybe the fund itself. That's it. Nobody else is on that. There is no fractionalization. That's a no-no.
Okay. Mr. Anonymous, I don't know who you are. You mentioned context of the insurance policy. You stated that most insurance company personnel don't know how to do this. How is this possible?
Oh, I didn't say that. What I said is at the time, there's most of them don't know what a conduct rating of a carrier is. That's what I said.
Okay, got it. Do you have to convert a term policy to whole life or UL before you can sell it? How long
No.
does it take to sell your term policy?
The answer is no. And again, depending on all the multiplicity of factors involved in selling it.
Okay, that would be a really good question for personal consult. Okay, we're
Yes.
getting down to 4 questions. When does it make sense to approach you as an accredited investor in the debt in the club? Your website has no information. When does it make sense to approach you as an accredited investor?
And
I'm
credit
assuming,
investor it can go in either one, the H Harry or the estate portfolio management. And there's a box there that they can fill out and a phone number they can call there, and then they'll set an appointment.
yeah, if the website's not clear enough for you, set an appointment and talk to somebody. That's
It's
old
got a
school.
fill-in box. It has a fill-in box on both, I believe, on both websites.
Okay, good. If I have funds currently, some in IRAs and some in annuity, can what can I do to convert the whole or term policy so I can get a better ROI?
Okay, so depending on how long that person's been in the annuity, sometimes we can offer a reimbursement on surrender, depending on how long, how much, the rest. Again, that's a lot of factors, but sometimes that happens. Sometimes we do it based upon, how much money's involved and like how well I think they fit um, what it is and how we do it. It's like, again, like I said, uh, all of our business as a private fund is referred. We don't advertise. We don't want to advertise. We haven't never advertised. Our whole institutional fund was come to us by referral. So we look at each client is if, it's us, and is this a good fit for the client and for us? And if not, we just tell you, but we try to send you in the right direction. If like you have a policy, you want to sell it, I'll send you in the right direction. Or you want to buy one outright and pay premiums and things like that, I'll send you to the right place to get it. At least in all, good places to go and do these things.
And you're suggesting that you're probably not going to send it to somebody that advertises on TV.
Well, probably not. Uh, because they get so many, I'll tell you why too. They get so many policies just sent in that the chances of, I mean, it's like a used car lot. Okay. You want to go somewhere who's going to take some care in the policy that you're selling, right? I mean, that's what I would want to do.
And
But
if they're spending billions of dollars on TV advertising, that's probably going to cut into the profits of the investor.
that's right. Exactly right. Somebody's got to pay for that.
Some somebody does. All right, we won't mention Mr. Wentworth's name. Okay, does Mr. Hagan have any Canadian life insurance agents that they can assist me to sell this life insurance policy? Do you know if
I
it?
I'm
Okay,
sorry, I do not. I got them all over the United States, but I do not have any in Canada.
all right. Sorry, Theodore. Okay. Um, if an investor buys a policy, does the investor become the beneficiary on the policy?
Well, there's two categories that people need to know. It's the owner and the beneficiaries, you know, secondary beneficiary, tertiary, third beneficiary. So in other words, the owner can be the owner and beneficiary, or he can be the owner and then two sons and a daughter are the beneficiary, or two daughters and a son are beneficiaries, or his wife. And then, or lastly, it can be irrevocable. He can say, my wife is irrevocable on this policy, and that's that. So there's different categorizations, but the one who decides who is what is the owner. It's not the beneficiary, it's the owner of the policy.
Okay, got it. All right, I don't understand why you say it's not the right investment for someone who only has $100,000. Please explain.
Well, most of the time, it's because it's an alternative financial transaction. See, what we don't want to have happen is someone who, and there's nothing wrong with $100,000. Please don't misunderstand me.
Right.
But the point is we don't want somebody to come in and then that 100,000 is so important to them that if something happens, they're going to need it back out. Because what that means is it's not that we won't give it back to them. It just means we're going to do a lot of work for nothing and it won't be worth the bang for the buck for the client or for us. Because if they pull out, they're not going to get the return. And if they were on an income product, they're going to forfeit their interest payments that were paid to them to that point. So it's we look for people with actually more money than that so that they can, it's just part of an overall diversification plan rather than it's all here, it's all in one place, and we're responsible for it. We just would rather not be like
And
that.
Jeff, let me take a stab at this too. If you had $100,000, that's all we have to invest. Would I buy a rental property that costs $100,000? Well, there's no money to fix it up. If I need the money out, if a little catastrophic life event happens, it's not liquid. Stock market is liquid, bond market is liquid. If that's the only investment, the only money that I have, there's no wiggle room. And it's not a liquid. You're buying a long-term hold product. It's kind of like mineral rights. It's not something you would stick everything into. Uh, the best investors is people that have a little flexibility, that they've got liquidity, and this is an
Right.
alternative investment. Is that fair to say, Russ?
Yes, that's it exactly. It's again, I think we at the beginning we started that way. This is an alternative asset class. It's an alternative. It's not where you should have all your money. And I said I like stocks, I like bonds, I like mutual funds, I like all of it, real estate, I like all of that. But it's not, this is you got some extra that you need to diversify your portfolio because you got too much over in pocket A, B, C, or D. This is a good place for it. That's the kind of thing for it. But if all I've got is this amount and I want to put it here, I don't think that I would suggest that's not a good idea. In fact, I would not take that money because I just don't think it's right for the investor.
And it's not that, it's not like gambling. I only go to Vegas and spend the amount of money that I can afford to lose. It's safe, it's secure, it's a great investment, but it's really more about liquidity, is it not?
Yes, pretty much so. This is a bit, more of a long-term vision, even though people are going to get payments on the first quarter on the income side that they put the money in, it's still something that's, if they need their money back out, then they're going to forfeit those interest payments. See, it's an ouch. And we don't want people to have ouches. We want them to, if I would, I mean, I'm not going to tell anybody what to do with their money, but that kind of money, I mean, some of the places are paying 5.75% in a CD account somewhere. I mean, they're out there.
And it's
That'd be,
liquid.
and you can only, and then I got 2 years, or I got 12 months, or I got, it's just our time frames are longer, 7 years, 10 years, 5 years. they're longer time frames.
Russ, I've had hundreds of students come to me who've gone to their accountants, gone to their attorneys, and say, "You just don't have enough money to protect." Are you kidding? It's all I have. It may not be, on world standards. It may, you know what? If this is all you have, it's worth protecting. And
Hmm.
and I feel the same way about investing. If this is all I have, I want some diversification. I don't want to put it all into one asset class.
Hmm. Exactly.
Okay.
Exactly
All
right.
right. One more. Is the average 10% investment on a policy before or after taxes? That would be before. What's the basis of the policy when capital gain is calculated? I think you've answered that. You're not an accountant. Is that fair?
Right. Right. I'm not gonna go down that road. But what we do is we position it either in the accredited fund, the 7 year 7% annualized paid quarterly. The end of the 7 year, you get your principal back, or you can reinvest, or we can go our separate ways. This 10 year 10% is $1 million minimum. Same applies. It pays quarterly, right on time, all the time. The fund is over 10 years old. We're doing just phenomenally. We're growing over 30% a year. The other fund too is right after that, the investment club fund, and that's a lot of people who just work with a group team that invests in either policies or income as well. So um, we we designed this as an alternative market segment to target that market that I felt was I used to be an analyst for one of the stock market firms, and I wanted to create something that was unique and different and yet asset backed that had the security of that asset. And that's what this does. I mean, there is nothing better than a US life insurance policy to back anything. And a lot of banks even take it as collateral now. So great, great product, great product.
Okay. And with that, anonymous, I don't know the basis of the capital gain. Again, we're gonna
I
avoid
can't
that question.
check with your check with your accountant and see what they would have
Yeah,
you do.
there we go. All right, and with that, Russ, I appreciate your expertise. I know it's really late on the East Coast. I get that, but I appreciate you stick around with us. Any other closing comments for you before we bid you goodbye? Thank you. We so appreciate your time. Thank you.
Oh, I enjoy doing it, and we've known each other quite a few years, and I work with some of your experts. I've
Yeah.
engaged some of your attorneys and offer some work for the firms. So I appreciate the work you've been doing and have been doing for all these years. I mean, it's really outstanding, and I'm glad I had an opportunity to just share about this, just to open up people's minds, and so they can think, hey, if this does come around, if it does happen, wow, I got this policy. I don't have to leave my home. I can sell it, or I can watch my three kids instead of struggling. I can buy them a house. I mean, those are things that, I have three children. I love my kids, and you know, uh, it's just I love families, and I think it's a real asset that can help families if they win in time of need, even. So glad I was able to do it and present it. And I remember one clause, it's one of my favorite sayings. I'm more concerned of the return of my money than the return on my money. I
Ooh,
always
there
like
we
that
go.
one.
And students, we've known Russ a long time. We absolutely trust him to put on our stage, and I anyway, very much appreciate. Tell your
Thank you, Doc.
sweet wife hi for us, and
Sure will. Sure will. She'll tell
um,
me, she'll say, when's the next Alaskan cruise?
I know, I know we've got to figure that one out. All right,
Love it.
students, thank you for being here. It's been a long night, and so we'll let you go.
All
Russ,
right.
appreciate you.
All
Have a
right.
great
Thank
night,
you.
everyone.
Thank you again, guys. Thanks.
Thanks, Russ.
Bye bye.